Hello students, welcome to my class. This is Professor Vincent Osaya, and this is the presentation of part 1 of chapter 13, chapter 23, statement of cash flows. Now, let's take a look at the breakdown of this chapter. Chapter 13 is breaking down into 3 categories. The first part is we are going to talk about the preparation of the statement. Then the second part talks about illustrations of the statement, an example of the statement. Then part 3 talks about special problems in statement preparation. And the last part talks about a worksheet. So, first of all, let's take a look at the overview of chapter 23, statement of cash flows. You are already familiar with 2 important financial statements, income statement and the balance sheet. All right. We said that the income statement is a financial report that shows the performance of a company within a period of time, and the balance sheet shows us the financial condition of a company at a point in time. Now, listen to this carefully. In addition to the income statement and the balance sheet, the statement of cash flow is another required financial statement. Now, unlike income statement and the balance sheet that are prepared based on the accrued basis of accounting, everybody is familiar with accrued basis of accounting. The accrued basis of accounting says we should recognize or record revenues when earned, not necessarily when cash is received, and recognize or record expenses when incurred, not necessarily when cash is spent. So that is the accrued basis of accounting. So the first 2 statements are prepared based on the accrued basis. However, take a look at this. Statement of cash flows zero in only on cash. In other words, it is strictly cash. So on the balance sheet, as you know, we have assets, liabilities, stockholders' equity. Under the assets, you have what? Cash, right? Now, take a look at what we are doing here. For the statement of cash flows, we are preparing a whole statement only for one line item in the balance sheet. So the question is, why? Why are we preparing a whole statement only for one line item? Why? The answer to that question is this. Cash is king. Cash is extremely important. Cash is critical to the survival of any company. Now listen to this carefully. You know, there are a lot of companies that are very profitable. They make a lot of profit. But guess what? Sometimes they go out of business. How can a company be so profitable and at the same time go out of business? Is that possible? Yes, it is possible. Let me give you an example. If you have an income statement, a company has an income statement, look at this. Revenue is $300 million, expenses is $100 million, and the net income is what? $200 million. Is that a good performance? Yes. That's $200 million for all practical purposes. Let's assume that this second year, the company also reported another $200 million profit. But guess what? If most of the revenue, it is very easy to realize profit. Why? Because one way of making a lot of profit on net income is to extend credit to every Tom, Dick, and Harry. What does that mean? Just extend credit to everybody. If you do that, what happens? You recognize what? Accounts receivable, $300 million, and sales, $300 million. So if you are not able to collect your accounts receivable because you extended credit to every Tom, Dick, and Harry, you can be reporting a respectable, beautiful, nice net income. But if you are not able to collect, sooner or later your cash position is going to be compromised, and sooner or later you'll be out of business. So that is why cash is extremely important. As a matter of fact, during the recent recession, I had some clients that were doing very well, have a lot of assets, but they did not have enough cash to weather the storm. So that is the reason why investors want to know exactly what is happening with your cash. Where are you getting your cash from? How are you spending your cash? So cash is that important. Hence, we are required to prepare a whole statement strictly for cash. So this statement is strictly cash inflows and cash outflows. Now, having said that as a backdrop, let's take a look at the preparation of statement of cash flows. The primary purpose: to provide information about the company cash receipt and cash payment during a period. What is the secondary objective? To provide cash basis information about companies operating, investing, and financing activities. Why? Because the companies operating, investing, and financing activities as reported in the income statement and balance sheet are prepared on an accrued basis. But here we need to take a look at just cash and cash alone. Moving along, let's take a look at the usefulness of the statement of cash flows. It provides information to assess what? Entities' ability to generate future cash flows. What does that mean? The past is usually a good predictor of the future. So investors are able to take a look at how the company usually receive their cash and where the cash is coming from, and that can help them determine how the future cash flow is going to comes about. Number two, the entity's ability to pay dividends and meet obligations. If you are an investor and you have a company stock, you are interested in making sure that the company has enough cash to pay your dividends in the future and meet obligations, okay? Now, the statement of cash flow will also help you to determine, yes, net income is $200 million, but how much of it are you able to collect in cash? So the statement of cash flow is going to be able to help you do that. Number four, cash and non-cash investing and financing transactions are also discussed or reported in the statement of cash flows. So that is the first objective. Let's take a look at the second objective. Preparation of statement of cash flows, classification of cash flows. Now, take a look at this. We are already comfortable and very familiar with the income statement and the balance sheet elements. So if I ask you where the sales revenue is reported, sales revenue, you are going to tell me revenue is reported in income statement, right? And then expenses, we have revenue, expenses in the income statement. You're already comfortable with that, you're already familiar with that. Then when we go to the balance sheet, you're already familiar with that, you're comfortable with that, assets, liabilities, stockholders' equity, and you know the definition of each component, and you know how to report each component. And take a look at this. Statement of cash flows is a different animal altogether. In statement of cash flows, we have three categories, just like the balance sheet. So in the statement of cash flows, we have three categories. Number one, we have operating activities. Number two, we have investing activities. And number three, we have financing activities. Now, listen to this very carefully. It is very important for you to know the definition of each component or each class in order for you to know how to report cash inflows or outflows under each category. Now, for the previous financial statement that we talked about, you know what is liabilities, assets, so on and so forth. So that is one of the challenges for this. And of course, it is going to be part of your examination in terms of knowing what is financing, investing, or operating activities. So let's take a look at what they have here in terms of the definition of each. I'm going to start with this, financing activities. Let me explain this to you. Think about somebody starting a business. I know most of you have heard about your relative, uncle, auntie talking about starting a business or the challenge of starting a business. What do people normally need when they start a business? Financing, right? Say I need capital, right? Capital financing. How do people get money to start a company? One of two ways. Number one, the owner put in his money or you borrow, right? Equity versus debt, right? So if you look at it from that standpoint, financing activities deals with the cash inflows and cash outflows from financing. So guess what? When a corporation wants to start a business, to raise money, what do they do? Publicly traded company, they issue what? They issue stock. When you issue stock or sell stock, what do you normally get in return? Of course, cash. So that is what? Cash inflows. So that would be cash inflow under what? Financing. So on the statement of cash flows, we have operating, we have investing, and we have financing. So on your exam, I'm going to give you some transactions, cash inflows, cash outflows, and ask you which class does this cash inflow or cash outflow belongs. So you have to be able to tell me either financing or investing. So understanding that the definition of each is very critical. So look at what we have here, stockholders' equity. So activities relative to stockholders' equity, are these with our financing activities. And of course, like I said, long-term liabilities, right? For example, when you issue bonds, you receive cash. That is cash inflows under financing. So that would be this would be the conclusion of part 1 presentation of chapter 23.